Well, thanks very much for having me. Much appreciated.
Hey, thanks for being here. And I wanted to start off with the economy. I mean, the market has been crazy in the last couple of days here. Do you think the global economy, do you think it's fragile right now?
Well, I do, and I've thought it's been fragile for a while. And listen, the biggest thing is when you just look at history. I'm one of a few people in this business who's actually lived through a few cycles, and that's important because there's a significant portion of the investing public that hasn't. Um, we've been what now 12 years without a recession in the US, called, well, 11 years, let's call it. That alone is enough just historically to make someone concerned. But then you look on top of that with the fact that we've had these crazy perverse incentives in the economy, particularly, anytime you're approaching zero or in fact negative real interest rates, it has to have led to the building of excess capacity, right? There's just sure we've been fueling that with the ability to borrow and consume with low interest rates, but your basic macroeconomic and microeconomic policy would tell you that super low interest rates will encourage capacity addition. I think there has been capacity built. And when you get into year 12 of an economic run, yeah, at some point it's going to pull back. So that combined with, the levels of indebtedness, both personal and corporate, really throughout the world, and government for that matter, levels of government indebtedness, all leads me to believe that, yeah, we're in a pretty precarious position, particularly because governments just don't have a lot of policy alternatives. And we've seen it in the last week. What happens in the olden days when government cuts rates by 50 basis points, that would have actually helped lift a stock market and give people confidence. Now, when you're cutting rates, when they're already negative from a real perspective and you're cutting them even further, it all just speaks to, I think, what is a pretty precarious feel in the economy.
Do you think the rates here in the US, do you think they're going to be pushed into the negative territory?
Oh, that's an interesting question. Listen, from a real perspective, they already are. So whether the nominal does or not, I don't think that actually fundamentally matters. And it might matter a bit from a psychological perspective. But if you're sitting at Fed rates where they are, and you look at kind of where the U.S. 10-year is right now, it's hard to think that they don't go negative, right? If you're looking at any other kind of further policy stimulus, which there's going to have to be if this is real impact of COVID-19 on the fundamental economy, then yeah, I think there's a real risk that you have it go, actually negative on a nominal basis.
No, with this COVID-19, companies and governments, they're all looking at their supply chains. And now they're saying, something, maybe it's not a good idea to have everything in China. Maybe we need to decentralize or renegotiate how we distribute and how we manufacture and where we put our manufacturing plants. Do you see this interrupting or destroying the globalist model?
Well, listen, I think there's been cracks on the globalist model for quite a while. And, I'll come right out and say that I'm an unabashed globalist, right? I'm a believer in efficiency and movement of capital into its most efficient uses from a macroeconomic perspective. But, I think this has only kind of served to highlight what some of the challenges are of, and the risks to being globally integrated. But I think there are far greater risks to a lack of global integration when it comes to, ultimate world peace and things like that. I think we are better off, needing to rely on each other more. But that's just kind of my own personal worldview. But yeah, listen, we don't have a lot of business in China. I can't tell you other than anecdotally in my life, things that have been interrupted in shipments, From the perspective of someone developing gold projects in Canada. Yeah, it's I think we're seeing it, through a bunch of other parts of our lives right now.
Now, with the stock market, which has been bouncing up and down, I mean, way down, back, and then it brought back up. We've also seen gold, where in the beginning, when the market was coming down, gold was going up and then it dropped and then it went back up. I don't know what your take is on gold and what's happening here, but do you see gold breaking out like we saw in 2011 to maybe 1900 or even higher?
Yeah, well, listen, I think we need to have a look back and remember what caused gold to run in the wake of the global financial crisis of 2008. And the narrative went like this: if you can imagine going back to those times, the global financial markets were on the verge of collapse. And I don't think any of us really appreciated how close the markets were to an actual collapse. But in the wake of that, and real stress on the global financial systems, largely because of a debt crisis that was subprime mortgage, and some irresponsible practices around that subsector of the financial economy, but in the wake of all of that, the U.S. government was going to run a stimulus package that, if you could believe it, the deficit was going to top $1 trillion. And that was unfathomable to people. And so they said, listen, this is going to be the government printing money, and how could we ever foresee a situation in which this deficit's going to be reduced, and all the rest of that. And that caused gold to basically go. You can look from the sort of 08, 09 pullback into the 700s up to 1900. But I think you need to look at the gold run more from really the perspective of where it was in 2002, 2003, kind of that sub $300 gold level. Which was sort of where it settled out on kind of a supply demand basis and the long-term cost curve. And it ran from there to 1900, which is, you're talking about 6x, from that rebasing level. So, I mean, I would argue, not necessarily saying it's going to run, to these levels, but if you think of the $10, $50, $1,100 gold as the new rebasing of that floor, based on supply demand fundamentals and, ultimate marginal cost of production, at the 90th percentile of the cost curve, I would argue, is there something to say that in this push, you could see gold up 5x from that $1,100 range? I don't think it's impossible. I really don't. And the difference is, even in 2008, 2009, governments had more flexibility. Central banks had more flexibility. You were dealing with a situation where, you hadn't had rates at negative real interest rates for, a year or two before you went into this crisis. So they could actually stimulate the economy and give people comfort on overall borrowing levels. But then just look at the amount of debt that's been added globally from 2009, 2010, 2011. It's astronomical. So ultimately, the ability to raise rates when the economy recovers is going to be in question, just because of the indebtedness of societies. But all that said, when you look at it, all boils down to what the policy options are. And I think when you look at the policy options that central banks have, rates are about as low as they can get. Maybe they can cut them a little bit more and we go, nominal negative around the world. But this stimulus is going to have to come in other ways. And those other ways are going to be, ultimately, monetization of that debt. And that's going to be printing money. And when people really get a sense of that, that's when you are going to see, people beyond central banks and those of us kind of in and around the gold industry being buyers of gold, when the mainstream population is looking around the world at what is a safe haven asset that's not manipulable as much as fiat currencies. That's when I think you're going to see a real push. So I think we're in very early days here. Now, that said, the gold industry doesn't really need gold much higher than this. I think, you're starting to see record free cash flows coming into gold producers, but I think you could, on the basis of, just funds flow, ultimately see gold go a lot higher than where it is now.
Now, I've had many people on the show, and we always talk about, is there shortage of gold or is there a lot of gold? Some people say there's gold in the Grand Canyon. And I wanted to get, since you're in the business, how difficult is it to discover gold in an economical amount?
Oh, the finding new gold resources is a real challenge. And there's some great data that's been put out that would say the average cost of finding an ounce, actually sort of delineating deposits. So after you spend all the money to discover something, and that's a very expensive process because, the gold that's near most infrastructure has largely been explored for and discovered. We have new technologies coming out all the time that's making exploration more successful, but it's still a very high risk, low probability scenario. So once it's discovered, the cost to drill out an ounce of gold to sort of delineate a resource on it, which, once you find it, you need to know if you have it in sufficient size to be economic. That, if you look at all of the delineation drilling done from, S&P did a great study. I think it went from 2011 to 2018, maybe 2019. It was something like $36 US an ounce to delineate the ounces. Now, that's only frustrating for companies like ours who are sitting on 11 million ounces of gold in a portfolio of 6 projects in Canada near infrastructure that we're, advancing engineering studies on and showing, real economic, attractive economics on these projects. And we're trading today. You can buy our ounces in the ground at less than $10 US. So not just the probability to find it, but the cost to drill it out. You're talking, probably 5 or 6x what we already have established in the ground.
So Trump, he's talking about infrastructure programs. Is that bullish for commodities?
It's bullish for some commodities. Certainly, depends on what the infrastructure is. It's going to be, bullish for some of the, steel producers, iron ore producers, copper, zinc, other sort of the industrial metals. But again, I think, he's starting to talk about a big infrastructure push at a time that he wants to stimulate the economy. Well, how are they going to get the money to do it? They're going to have to borrow the money to do it. And that ultimately is, I think, exacerbating the case for gold. So it would sort of be a bit of an indirect beneficiary of it. But yeah, it's very interesting world that we're living in right now.
So since gold is making new highs now and everyone's getting excited, what is the strategy of First Mining Gold? Is it the same? Has it changed?
Yeah, so, this company was set up in 2015, really, by Keith Neumeyer, who was the CEO of First Majestic, who, if your listeners may know, Keith's a pretty well-known guy in the mining business. And he and a few like-minded individuals were looking around in 2015, which was a market that looks and feels quite a bit like we have now. This is from a mineral development perspective. We'd at that point been in 4 years of a bear market in minerals, and particularly for gold developers. And they looked around and said, you could not hope to spend money to explore and find resources any cheaper than you can buy good projects right now. So they established a public company and bought 8 projects or companies in about 12 months. So a real acquisition point. And the game plan then was, this is going to be a mineral bank. So it's great. We'll buy these projects. We're not going to do much to them. And then the cycle will change and we'll find partners for them, have other people move them forward, retain interests, and we'll all walk away happy. So as I've said to a lot of people, the challenge that the company has had is that the assets that Keith and the team bought are good assets. You can be a mineral bank, and if you're buying assets that are never going to be developed, if you buy them at $2 an ounce and they trade up to $10 an ounce, that's a good model, and it's a perfectly viable model. But I think the strategy that we're moving forward, particularly with our 2 main projects, is that these projects should trade in some, relative fashion to their fundamental value. And our Spring Pole project, we put out a preliminary economic assessment update in October of last year that shows that at a $1,300 gold price, the after-tax NPV is 841 million US. And at a $1,500 gold price, it's 1.2 billion US. So that's more than 10 times our current market cap. Now, development projects over a cycle, once they have their permits and are ready to produce, will tend to trade at sort of 0.5 to 0.7 times that net asset value. So we looked at that and said, well, the Spring Pole, if we can take it through and get it permitted, we are going to have something that we think is going to be worth, 450 to 600 million US. That's a pretty good return from where we are now based on what we think is a pretty manageable capital investment to get it there. So we're moving forward now, taking Spring Pole through a pre-feasibility study and ultimately aim to submit early next year its environmental impact statement. And that will start what in Ontario in Canada, which is where Spring Pole is, located close to infrastructure between a couple of great historic mining camps in a part of the world where they've permitted 4 big open pit mines in the last 4 years. But if we can get the permit for Spring Pole, we think that's going to unlock an enormous amount of value. And based on the data that we have, we're very confident of our ability to do that. So in some senses, we're, kind of transitioning from what I think is a bit of a cap at that $10 an ounce level into when people really believe that we are moving these projects forward and we're going to be able to surface value from them, then, I think we start seeing this trade up toward the value of other developers, which today is probably $35 to $40 US an ounce. And late stage development that in historic markets and in positive gold price environments should be, north of $100 an ounce.
So since you mentioned Spring Pole, a number of reputable analysts give First Mining Gold price targets that are 500% higher than the current price. So why is that? Can you explain that?
Listen, it comes down a little bit to the environment we've been in for development companies in the mining sector. And the sector overall has really had, from 2012, let's say, kind of the last rollover of the high gold price, the industry has been really starved of capital. So producers had taken on a lot of debt as they grew the companies up to 2011. So they have basically been cutting back. They've been, merging and rationalizing portfolios, selling non-core assets, and really rationing capital because the free cash flow in the industry at $1,250, $1,300 gold was, call it $200 an ounce, $200 to $300 an ounce. So, what that meant was that, developers like us, who are a longer time frame to get to production because we have to go through permitting processes and through feasibility processes. Investors just kind of looked at it and said, okay, well, big capital drain. No real line of sight on where you're going to get the capital from. So, we'll wait. And it's, not just us. It's a number of our development peers, have been trading at a 0.1 to 0.3 times net asset value for our main projects. And that translates into that, call it $10 to $40 an ounce in the ground. But this is changing, and it's not changing so much due to external access to capital. That hasn't really arrived yet. And largely because, our industry, like a lot of industries, has been impacted by the rise of exchange traded funds, right, that are basically passive investors, index funds, that those funds can't allocate capital to good projects, right? There's the allocation of capital in an ETF world is really just what's your index weighting. So you need more size and scale. And it's also been impacted by the fact that there hasn't been free cash flow and, a path to development from gold producers. Well, what's happened since May of last year is that the gold price goes up to $1,500 plus, and the free cash flow to the gold industry has basically doubled. And we've really only seen 2 quarters of that reported so far, the sort of September and the year ends. But if you actually look at the free cash flow generated by gold producers, it has more or less doubled. And on top of that, they're all basically declaring right now that they don't know where they're going to get how they're going to replace their reserves. They don't know where they're going to get their next projects from. The CEO of Barrick stand up a couple of weeks ago and say we're at peak gold. Like, the industry cannot replace its reserves because we haven't spent the money to find the deposits or to develop the deposits. So at the same time that they're now turning the corner into really record free cash flows, they have this desperate need to replace their reserves. So I think that sets up basically a perfect situation for gold developers like us. The only question is going to be, can we stay independent long enough before all of the largest mining companies in the world go on a feeding frenzy? And it might not be 3 months from now, because, everyone's still kind of feeling out the fear part of this run in gold. And it's very much been a lift on fear. But when that turns to the greed lift and people realize how much money that gold mining companies are making, by the way, not just because the gold price has gone up, but what's a major cost input in the mining industry is diesel fuel. And the cost of your, with oil at $30 or $35, you'll have seen a, 30 or 40% drop in one of the most important input costs in the industry. So, we're setting up for just record cash flows at a time when no one really seems to have been paying attention to the industry. So that ultimately, I think, is going to be very positive for us.
I mean, we have a huge amount of debt, low interest rates. Like you said, diesel fuel's coming down. We see other oil prices, they're coming down also. When the gold price continually rises and people start to catch on and they say, okay, wait a minute, gold is rising. We have a huge amount of debt. Interest rates are falling. I'm holding on to this paper currency. Are people going out of fear or panic or whatever you want to call it? Are they going to be looking at this saying, something, maybe I should get into gold?
Listen, I think so. What you're going to see, and you're seeing it in a lot of sectors now, and you look at the best performing sectors in the world, there's no question that the gold mining sector, other than, maybe medical equipment suppliers or people selling, surgical masks, the gold mining sector is going to be the best performing sector around the world by like an order of magnitude, particularly amongst the producers. So, the reality is most investors, and the opportunity in the investing world is that most investors are return seeking, and they seek return in a trailing basis based on when something has already started moving. So I think that should have investors paying attention to the gold mining sector, which they haven't had to since 2010 or 2011. And they're going to look at ultimately they'll look at the degree of protection that gold and gold equities offered in this downturn, which, some of these things have sold, but they're still on a relative basis, relative to pretty much everything else in the index, they're still feeling pretty good. I think the gold as a metal is doing its job, and I think the gold equities are going to reflect that. Maybe, not in the next 2 or 3 weeks, but same thing happened in 2009. In the panic, everyone sold everything and gold sold off. And then in the sort of hangover of the panic, people looked around to realize, governments that are going to print endless amounts of money, how do I get exposure to it and leverage to it? And there's a degree of risk spectrums that you can look at. There's physical metal, there's, large cap gold producers, which have already had quite a big run. And then ultimately people are, I think, hopefully going to start looking at those of us in the development sector with meaningful projects big enough to be meaningful to the biggest mining companies in the world in good jurisdictions, with manageable capital spends. And people are going to wake up and realize that, we are trading at all-time lows. And there's, this is where you can get some real leverage to this higher gold price environment, with the difference being we're not waiting for the high gold price environment to arrive, right? Like, it has arrived. And we're still trading at all-time lows. The value discrepancy between gold producers and gold developers, I've been doing this for 27 years. I've never seen a discrepancy like this in an environment where the gold price has already moved. So anyway, we think it's I think it's still, there is still risk in this investment, but I think well chosen gold developers with good assets and good jurisdictions can really, really pay off for people as we move through the next 2 or 3 years in the cycle. So I hope people look at First Mining Gold, ticker FF on the TSX.
Great. Dan, thank you very much for being on the X22 Report Spotlight. Once again, how can people get in touch with you or get in touch with your company?
So go on our website, www.firstmininggold.com, and all of our contact details are on there. And again, it's the ticker symbol FF on the TSX, and we trade quite actively on the OTCQX as well under the ticker symbol FF. I should know this better than I do. FFMGF.
Great.